So, limited partnerships are, for the most part, some period of time. That mechanism has been in place for a very long period of time. You start to realize that markets have a mind of their own. Multiple investments in a pool sold to an investor, chopped up into little pieces, has been around for centuries.
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world. Welcome back, Superclusters fans, and today we have the one, the only David York. David York is probably someone who needs no introduction, but to borrow a line he's once used to tell people who asked what he did for a living, he's funded probably every app on the average person's phone in one way or another. He is the founder and managing director of Top Tier Capital Partners, which he spun out and founded after Paul Capital Partners. They're investors in names you're likely familiar with, including the likes of Andreessen Horowitz, Battery Ventures, CRV, Data Collective, NEA, Kindred Ventures, just to name a few. He is a fundraising genius. My words, not his. And you'll see why in this episode, having raised his first fund during the dotcom crash. So lots to learn there. He's also on the board of the National Venture Capital Association as well as Nest. And that's Nest with two S's. We get spicy today, covering is the LP model broken, to when's the best time to pitch overseas LPs, and tactically how to build long-term relationships. And of course, one of my favorite parts, what are the liquidity needs of different kinds of LPs? So without further ado, from one David to another, welcome to the show.
Thank you. Great to be here. Been a lot of fun getting to know you.
It's been so much fun. And I remember the last time we were at a bakery, which we may end up bringing up later in the episode. We had spent so much time talking about obviously venture and the world of capital allocators, but equally so about the culinary world. And I'm going to do a bookmark over here, and this might be something we revisit later in the episode.
Sure.
But I am absolutely fascinated about your expertise there as well. So if it might help as a lead-in to this episode, why don't we start with role models? And in the world of role models, let's go back in time. When you were 20 years old, were there any role models you particularly had? And did those North Star figures graduate or change as you turned 30, 40, and 50?
I started my professional evolution actually working for the family business, which started kind of around kindergarten. And so we were always working for Dad. So Dad was kind of this person that we emulated. It was a wholesale distribution company, but he showed up in a suit and tie every day, even though his customers were contractors that came in off the street and were wearing muddy shoes and dusted pants. And so that was one of the things that got us going early, was just, you had to look the part and have your head on straight and be up in the morning. And then it taught us how to work hard. I mean, we sort of 24/7 for a very long time, especially in a family business. And then as I got into working out of college, it was a similar sort of experience. But my first job out of school was really focused, getting back to your question about the 20s, was at a financial firm called Payne Weber, Jackson and Curtis. It was a wirehouse stock brokerage firm. And the guy who hired me was a guy named Bob Donato. Bob was this quintessential New Yorker, transplanted in Los Angeles, wore suspenders, smoked cigarettes. But he had this charisma about him that you just felt like you didn't want to let him down. And so he was one of the people that I always felt I needed to produce for. And it kind of, as my career evolved over time, we kept working with similar people. I had the pleasure of working with a guy named Sam Hunter when I moved from Payne Weber to Drexel Burnham, and Sam was famous for building Merrill Lynch's equity business, and ultimately got recruited across the street to Drexel, and he was trying to do the same thing there, and I became Sam's guy to do his sort of side trades and things in corporate America. That put me in the role of running businesses. In the 90s, the one role model that I really felt I needed to live up to was a guy named Dan Case. Dan is the older brother of Steve Case. Steve is a good friend and somebody who started something called Revolution Capital, and we've been actively involved with as he got that off the ground. But Dan ran a small investment bank here in San Francisco called Hambrecht Quist. And Dan was, very young for his role, but on top of it, just incredibly poised. And so you always wanted to make sure you didn't disappoint Dan. And so we built a business at H&Q that ultimately led me to develop all of the general partner relationships that ultimately became investments here at Top Tier Capital Partners.
For the purpose of this not being a Lex Friedman 8-hour long podcast, like there are so many things I would love to double down on and ask about, but for the sake of time, if we could take fast forward a little bit, one of those chapters, because I want to talk about a seminal moment for your career, which was the world of starting Top Tier, which obviously spun out of Paul. One of the things, even maybe before we get into that, because one of the things I've deeply admired in our interactions is the way you think about the world is very framework driven. And it's like you take these, so to speak, chaotic pieces of information in the world and you make sense out of it in a very concise way. Even to the point, and I didn't have this on the roadmap for this conversation, but even to the point where right before this conversation, you're like, well, there are certain economies prefer different types of whether it's yield or equity or assets and all these kind of things, right? And the flip side, and I'll use this as the lead-in, so to speak, is you mentioned, is the limited partnership model broken? And that is too good of an anecdote and a question not to double down on. And I told you to reserve your thoughts for the actual recording itself. So could you elaborate why that question is so important to you? Is the limited partnership model broken?
For those that weren't in our conversation beforehand, David had asked me, what's something in our world that we think is could be fixed, or what is the one thing that if you had an opportunity would think about? So, limited partnerships are, for the most part, some period of time. There's a couple extensions. There's a structure where you get paid a fee, but there's really incentive to produce returns. That mechanism has been in place for a very long period of time. It's been in place for a very long period of time, but it started originally, way before the United States of America was ever a country. With some of the speculation that went on in the UK and throughout Europe around conquering the New World. There were things like the whaling industry was really the first true limited partnership contract with whalers and their sponsors. And so the capital that goes into those things has been doing this for a long time. So I am a believer that if you look at venture capital investments in general, the partnership agreement is too short because of where we are in the capital market ecosystem around investing in startups. On one hand, on the other hand, the capital provider is so used to a certain structure, for centuries, if you will, that it's very, very hard to get that to change. David and I have had several conversations about how capital kind of works. And because I sat essentially in an equity capital market business for off and on for almost 20 years, you start to realize that markets have a mind of their own. No matter what the Fed wants to do or the government wants to do or institutions want to do, things happen that really feel at a high level that there is some sort of emotional activity in the marketplace that kind of has its own soul, if you will. That sort of concept also applies itself to the vehicles that capital uses to make investments. If you go back into the beginning of time, in the UK, a listed investment trust was started early on so that common citizens could invest in British savings bonds because they couldn't afford to buy one on their own, but they could buy a basket at a smaller denomination. That was the start of the mutual fund industry. But that whole concept of multiple investments in a pool sold to an investor, chopped up into little pieces, has been around for centuries. And so partnership agreements are the same sort of phenomenon where even though we're investing in things we know are going to be held for much longer than 10 years, that's just the mechanism we're happy with, because there's been several people who tried to do 20-year partnerships, 15-year partnerships, and at the end they don't really work. It's kind of like the 100-year treasury bond. There was a thought that would be a great tool to push out the cost of capital. It still doesn't really fly in our capital market system. So I do think the partnership model isn't necessarily appropriate today on one hand. On the other hand, I just don't know if we'll ever get it changed. The other thing that's led itself to, which is something that we do quite a bit of, but it's created this opportunity to develop a secondary market. And that market has gotten more and more liquidity in it, to the point where partnership structures as they are actually are sort of becoming just a facilitation of capital moving into investments. And then the marketplace has created liquidity to accommodate investors' hold periods. So I'm, as much as I'm frustrated with partnership length on one hand, on the other hand, I don't think that's going to go away. And as much as people beat on that topic, I just don't think it's going to change because of the sort of emotional tie capital has to the structure, which has been limited partnerships for so many years.
If we were to play, I don't know, let's say the Disney movie version of this, the hypothetical utopia of where partnership models should look, and you can wave a magic wand, what would you have liked to see, or would you like to see in capital markets?
Private investing, let's just focus on that. But it's also evident in public market investing too. Long-term holdings of successful corporate investments has been the best performing asset class on the planet for a very, very long period of time. And, Berkshire Hathaway is a great example of that. There are some other private equity firms here in the U.S., and their hold period is essentially evergreen. And that structure is probably the most beneficial to holding equity and or investments. It's just hard for an investor to feel comfortable giving somebody their capital for an infinite period of time. But go ahead.
And when you say evergreen, I will be honest, my mind is biased towards evergreen fund models, which may not be what you mean when you say evergreen, because in my mind, evergreen fund models have like these synthetic, say like 2-year, liquidity periods where you can like take some cash out and all that. Is that what you mean by evergreen, or did you mean evergreen in more of the Merriam-Webster dictionary version of it?
Well, no, I was meaning evergreen fund models like you're describing. Okay. The early ones, the one that was actually one of the ones that are still thriving today, and was one of the very earliest ones, is a firm called Sutter Hill. It was started
phenomenal firm.
Yeah, by Bill Draper and who was and Paul Weiss and Dave Anderson, and I'm trying to remember Jim Gaither, and they were old-fashioned evergreen, and the reason they were is their original investor, which was a corporation in Canada, ironically, just told them to keep the cash, and it just kind of evolved that way. And then over time, there's been other firms. General Atlantic runs most of their money that way with the families they work with. But it's and in the case of GA, each of the investors have their own kind of deal, but the premise is they're going to be long-term holds. Endowments are kind of evergreen investors. If you think about the withdrawal rates there, they're very modest. They're less than 5% typically. Now they're buying things that aren't evergreen, so they have to manage both sides of that. But it does allow for the compounding effect to really play out in a very efficient way. Where if you're just trading stock or buying and selling mutual funds or ETFs or those things, it isn't quite so obvious, the compounding effect.
I do want to put a pin in succession planning, and I hope we have time to get to it. But
Sure.
I want to revisit, fulfill a promise effectively to the audience, where I talked about the beginning of Top Tier. And I want to spend some time actually talking about that moment, because one of the things you mentioned in our conversations is that you effectively raised top tier, at least the fund one, in like the 2001 to 2003 era. And if we were to just like put our place in time during that era, that was the dot-com bust. Like nothing was getting funded. No one was really interested in just like financial instruments as a whole. But, and correct me if I'm wrong here, you raised the kind of largest pool of VC money in the two Gulf Wars. And so I'm curious, how does one actually go about raising a 500 million, close to 500, we're rounding up, $500 million fund during a time when effectively nothing was getting funded?
I got recruited to a firm called Paul Capital Partners, and they had just landed a large separate account in the 99, 98 timeframe, and to invest in top tier venture funds. And that at that time, top tier was a descriptive for sort of the upper decile performers of venture capital. And it was very clear who those managers were because of the success of the 90s, and in particular the internet explosion that happened in the late 90s. And so because of that success, it was very hard to access those managers because they didn't raise, bottomless amounts of money. They only raised a certain amount of money. And so the only way you could get access is you had to have relationships with them. And the fellow that recruited me was a gentleman by the name of Phil Paul, and he had a firm called Paul Capital. And Phil had the privilege of running a family office for most of the 80s. And when he did that, he had put a lot of those name brand firms into business. So we had these relationships. I was working at that time at an investment bank in San Francisco. My responsibility there was to cover that universe of venture capital managers. And so they were my clients. Phil put them in business. That landed a separate account with Phil. That gave us some pedigree to be in the fund business. But during the internet bubble bursting, which wasn't obvious at the time, everybody was way over allocated venture. If you go back into that period of time, venture represented 60 to 70% of the capital raised globally in private equity. So that includes buyouts, infrastructure, all of those things. And so the globe was full of venture capital. And so to raise a new program during that period of time was kind of complicated, if not very complicated. I was fortunate Paul Capital had an existing investor base and a pedigree in a way that I could use that as a reference to how we were going to be in business. But what I did was, and this is kind of an homage to kind of thinking about fundraising, we sat back and thought about who wants to be an investor in private equity and doesn't have venture capital. And at that time, the public reference laws, or what they call the sunshine laws in the States, or simply called FOIA, which is Freedom of Information Act. The FOIA laws were very open, if you will, across the U.S. Each state had its own version. And so a lot of the public pension funds had no exposure to venture capital. And so I thought, okay, in the U.S., that's a market that I should go address. And so we spent a lot of time working with the FOIA clients across the U.S., ended up landing a handful of public pension funds. At the time, state of Florida was the largest. And so what I thought when I saw that problem is I said, the problem here is not investing in our fund and or taking their money. The problem is the reporting that we send them that could be privileged through the sunshine laws. And so I changed the reporting format so that the reporting became anonymous and got the investors to become comfortable with it. So that was my fix for that problem. And then the other thing that was happening in 2000, which most of us aren't aware of, but in international markets like the Nordics and also Canada, they had changed their rules so that pensions and investors could invest more than 40% of their capital internationally. And so a lot of them had sophisticated private equity programs, but no U.S. venture capital. So I spent a lot of time on airplanes, flew around a lot all over the world. Our largest investor in that activity was Canada Pension Plan. And I think we were their fourth investment in their history at the time. And so Florida was trying to get in the venture business. Canada was trying to get in the venture business. We gave them a mechanism to do that because of our history and then the stability of the firm that we were operating in. You talked about the spin out of Top Tier. That was, going along the journey of building a business. We were building a franchise in venture capital at a time that it was not favorable to returns. If you think about the 2000s, and what was really growing very quickly, though, were people's allocations to private equity. And so I continued to find investors that were just starting new programs, wanted venture capital in their allocation map, and we became that mechanism. And so one of those investors, again, was the state of Ohio. Another one was the largest pension system in Germany. We had a bunch of medium-sized investors throughout the world. We picked up investors in places like Tokyo. Later in life, we picked up investors in places like South Korea and Australia. And these were all people that wanted venture capital, had done the math, figured out that if you're really going to own venture and want venture type returns, you needed to be biased to the US. And that's a whole nother conversation about why. But in general, the returns mathematically were very obviously pro-US. And they, found it in themselves to kind of decide they wanted a partner to help them with that, or an advisor, if you will, as opposed to doing it themselves. Because they thought, gosh, in the case of some of the public pension funds, we don't have enough team, and it's a long way to go, and it's super expensive, and we're not going to go spend that kind of money. We're going to hire somebody. And the same thing with the international group. I know where Silicon Valley is, but I don't know where the door is. And for better or for worse, Phil and I, had helped build some of those doors. And so we were kind of more insider than not. And that's really how the firm got started. And then in the kind of post the global financial crisis, we had the opportunity to buy ourselves out of Paul Capital. And that was really because, people were going two different directions. Paul really wanted to grow their secondary business, and we really wanted to grow our venture business. And there wasn't enough resources to go around. So it became very obvious that it was easier for us to become independent. And then we leaned on a couple of our LP relationships to help us. And that's how we became independent. There's a lot of sausage making in all those comments, but in general, that's kind of the short story about how we got to become top tier capital partners.
I want to dive deeper into the sausage making side of things.
Sure.
And so there are a few questions I have in my mind, and I'll kind of go with them in order. I won't throw them all at you at one point in time. But for those that are like, to put things into perspective, let's put it this way. You said you were flying a lot. And what did that typically mean? Did that mean you were, let's say you were based in the Bay Area and you were flying like out of every 30-day month, you were flying 20 days per month. What did that look like?
Well, so at that time, Zoom didn't exist. and neither did the smartphone. We were all on BlackBerries at that time. We had just
a bygone era.
Yeah,
still had landlines.
We had moved from Nokia to BlackBerry, and we still had landlines. Email was around, but it was a mechanism to get a meeting set up, and then you went and took the meeting. And so, we developed a pace, because you want to go to New York City to see LPs, and you pick a date. Guess what? Nobody cares. They're on vacation or whatever. So you kind of have to figure out kind of a cadence. So, for instance, going to see accounts before budgets are set helps get your brand and your story in the mind of the budget setter. So, in the case of the U.S., budgets are set in January and in July. Depending on fiscal years. In the case of Japan, budgets are set at the end of March, early April to get into the budget. For instance, in Tokyo, you've got to kind of be working on the client in the fall to get them ready to do it for the next fiscal year. Korea, the budgets are set in January, but really don't get executed on until the 1st of April. So there's some time in there where you can work on those things. Same thing is true with Europe. A lot of budgets are mid-year. So you've developed some understanding of patterns, and then you need to give yourself, for better or for worse, if you're raising money, 2 to 3 years of relationship building with clients. Either they're at a conference, or you go see them directly, or you're going to an annual meeting and there's a guy that you want to develop a relationship with town. And it's a little bit of what I call dripping, but you starts with a note and then maybe a phone call, and believe it or not, that works. Still.
When you say note, do you mean like an email note or? Okay.
A thoughtful email note. It doesn't
And what
feel
does
like
that typically look like? What does a thoughtful email note look like?
At least ones that resonate with me tend to have some genuine integrity about why the email note's coming to me, as opposed to just, what I call spam, which is, looks like a marketing note. And because I have raised money for the last 20 years, I have a lot of empathy for people that raise money. But I do want them to actually be purposeful about it, as opposed to just, spinning. And I think a lot of folks think it's easy to raise money. It sometimes is, but most of the time it's not. And it takes a lot of intention to actually get it to succeed. And that takes repetitive action, developing a relationship, turning it into a curiosity, ultimately solving a problem.
Yeah.
And then developing trust along the way, in a way that the problem is being solved with a person I trust. And that takes time and patience and I would say genuine integrity, which is something that's sometimes lost on people. I find investors don't like rejection because they want to be decision makers, and being rejected is off-putting in a way that they really cringe at fundraising. And to me, rejection is simply not now, not a no. So if you take that mindset, you can kind of drip on people, and trust me, the dripping helps.
I do want to ask you on something,
Sure.
because not only if folks haven't figured out through this conversation, I've also talked to quite a few folks that as well. And one of the things they said is and quite obvious at this point, is David is a remarkable fundraiser and he's a really good storyteller. And one of the things about storytelling in general is not measuring what comes out of your mouth, but by how much reaches the other person's ear. And so this is my long lead in per se to, there was a great top tier blog post back in 2017, I believe, which was aptly named "My Fund is Old Enough to Drive." I don't know if that rings a bell for you.
It does.
That talks about liquidity as a function of different LP personas, and going on the thread of understanding the limited partners or the capital allocators, family offices, sovereign wealth funds that you're trying to get in front of. For the untrained ear, could you walk through the liquidity needs of different LP personas that, let's say, a pension versus an endowment versus a sovereign wealth fund versus a family office, and what do most GPs or first-time LPs often getting into venture fail to appreciate?
The exit.
That's smart.
Yeah, because venture capitalists spend all their time on the formation.
Yeah.
And then some of this is history. If you go back into the 70s and 80s and 90s, when venture was really starting to really take hold, the general school of thought is if you build a great company, it would figure itself out. And it was just a matter of time. Capital markets have changed. At that period of time, American households probably were less than 20% in equity. Today, they're, closer to 60%. So the markets are bigger. There's a lot more buyers, a lot more things. The irony is with that, returns started to commoditize, and you needed to develop, essentially bigger companies so investors could get into them in a proper way and those sorts of things. And it became clear that if you had to do that, then you could actually hold them very long and invest in them when they were private for very long periods of time. And, at a high level, it gets back to this cultural thing about what people are interested in. If you look at bonds, for instance, most bonds are, between 5 and 10 years long. They're not 30 years long, although there's a 30-year treasury bond. Most bonds are in that 5 to 10 year period. And so there's this expectation of getting paid back in the ecosystem. This is part of the emotional soul of capital. It has its sort of thing it needs. And therefore, some investors are really adamant about that. I would say European investors really want they want the finality of the deal, and they really like that. And the U.S., we like that, but we also are happy to create our own liquidity to get that finality. Endowments are probably the best suited for long equity positions because they're trying to essentially scale capital for the existence of eternity with the endowments they work for. And so they're, if the thing's working, they're happy to hold it and continue to hold it because it just creates balance sheet gains for them. And so that's part of the reason why venture capital is like endowment capital, because it has such a long tail. Pension capital, different. Actuaries go up and down. Boards want to know where they sit, etc. So there needs to be some finality. Families change. People get divorced. People pass away. Different people in the family start to take over, have different opinions. Families want to make investments, want to buy companies, things like that. And so they actually like a little bit more what are called defined finality in their capital allocations, more so than you would expect. And then there are new entrants, I guess the other category that you want to talk about. And new entrants are institutions that have never really done private assets before. And there's still quite a few of those. A lot of them are international, and a lot of them are run by boards that don't trust private investments. And so as they get more and more comfortable, they want that finality too, because it just makes them feel like there's a term. It's fixed. I know at some point there's going to be an outcome. And so everybody's got its widget, but that's kind of where it all kind of shakes out as far as the lifespan of venture capital and private equity investments.
David, I want to ask you, and I left this teaser at the very beginning, and I said if we had time for this, I'd love to talk about this point, which is two things. I want to talk about food. This has nothing to do with venture capital. So for all our listeners who are tuning in from here on out for venture and or LP stuff, I apologize because I'm literally scratching my own itch here. But I want to ask you two things. One, I'm gonna be honest, I have not been the same since the dinner we had with quite a few other limited partners and all that. And I'm curious for you, as someone who makes a semi-annual pilgrimage to Japan, what makes Tonkatsu Suzuki just that special?
So tonkatsu, for those who are curious, Suzuki is a tonkatsu restaurant in food court at Tokyo Station. So a friend of mine and I've traveled to Japan since 2000, 2 to 3 times a year. Sometimes it's once a year, but on average 2 to 3 times a year. And we always are trying to find the best tonkatsu. It's always the moistest pork. They don't do anything else but pork. They don't do chicken. They do some shrimp, but I've now sat there and watched them make it almost annually, at least 2 or 3 times. They put the peiko powdered flour coating, and breadcrumbs and all that stuff on a couple times. They actually let it cure on there for 30 or 40 seconds because they let it set them aside and let the egg and flour and the peiko crust develop. They run it through 2 different heat cycles with oil. One, I think, is to get the crust fried, and the other is to get the meat cooked. Anyway, it's just a very magical, reliable thing. And every time we go, there's always a queue. But it goes fast. It's a working man's lunch. It's a lovely experience.
What it reminds me of, and I don't know if this is the right corollary for it, so David, you tell me here, which is if you've ever been to like a Krispy Kreme shop that has like the production line of the donuts,
right.
it's like seeing that. If I'm, let me know if I'm putting words in your mouth.
No, you're not. It is like seeing that, because literally the counter wraps around the cooking area. There's 4 guys back there. One is shredding coleslaw and making the salads. One is doing the miso soup. One is doing the tonkatsu frying. One's doing the dishes. They kind of run around, and there's another hostess doing all of those things. It's very well orchestrated. Everybody knows their place. It's one of the beautiful things about Japan.
And you mentioned salads, and I think this is like super underestimated there, but the salads are really good in Japan. Like the way they shred the vegetables, on top of that usually have some kind of like ginger garlic kind of dressing. I don't know what exactly it is, but there's something just so magical that cuts through all the heaviness that you might get from like fried meat.
Yeah, there's some acidicness, vinegar and sesame oil, actually, I think is what makes the salads kind of very, very interesting. There's other things in the dressing, but those are the 2 that really make it interesting.
I agree. All right, last question here. Once again, scratching my own itch. As someone who's since become a profound boulanger, like, what is the secret to a great starter dough?
Oh, well, so for those on the podcast, one of my I've got to do this. So first of all, I've been cooking for most of my life. My parents both worked, so my brothers and I all learned to cook when we were in junior high. So we all cook and we all enjoy it very much, and we've gotten to the point where our cooking is quite good. But during COVID, in April of 20, I just decided I needed to make sourdough. I don't know why, but I did. And so, ironically, about 2 years earlier, I had bought the Tartine cookbook. Tartine is a bakery here in San Francisco that most people know about. So followed his recipe initially, and then kind of between YouTube, cruising on bread sites and everything else, kind of evolved. What makes, I think, starter work, at least for me, is having some rye flour in the flour mix for starter. The other thing I learned over time is if you're not around, then just put it in the refrigerator. It'll come back to life. So you don't have to be so obsessed with feeding it every day, even if you're not home. And so I'll sometimes have the starter in the refrigerator for 2 weeks, and it'll bring it back out. You get it back to room temperature. You feed it once, you feed it twice, and away you go. And then I do think the quality of flour is super important for making good bread. And I'll do a couple plugs. There's a mill in Utah called Central Milling. There's a distribution outlet in Petaluma, but Central Milling is the flour of choice for most of the Michelin star restaurants in San Francisco. And so you can buy from them online. So I buy flour from them. There's also another flour distributor mill in Berkeley called Community Grains, and they are both organic. Community Grains is really obsessed with the quality of soil that the wheat grows in, and of course, Central Milling is obsessed with the organic wheat in general. But I mix the two in my bread mix, and it really creates a really, really interesting flavor, and it works really, really well for me. I will say that my wife is gluten intolerant, and she can eat this bread because the flour is so good. So anyway, it's just food for thought for those making bread.
There we go. At some point, we may have top tier bakery. So, sure.
Yeah.
Never say never, right? Like 10 years down the line, that may very much happen. I would like some royalties if that does happen, though.
Sure. But I bring bread to the office, and the employees are very, very happy with me. So
Perks of working at top tier. All right.
Yeah.
Well, David, thank you so much. As one last note there, obviously you're in quite a few places. You're quite vocal online as well. But where out of all the places, where's the best place for people to find you?
Probably on our website, as well as on LinkedIn. Those are the places that we spend most of the time with social media.
People know where to go.
Yeah.
And until the next, David, you're awesome. I loved every single second of this conversation. Took so many notes myself. Obviously have scratched my own itch, but thank you for sharing.
Our pleasure. It's great to be here.
All right. Till next, stay awesome. Nope. This is the one. This is the one. You ever seen the face of a child right before they open up their Christmas gift? Oh yeah, you're looking at that right now. I want to give a special shout out to today's sponsor, Alchemist Accelerator. Backed by the likes of Coastal Ventures, Mayfield, Salesforce, just to name a few, Alchemist is the top B2B startup accelerator that's been around since 2012, backing founders from day one. And if you've been around for 12 years and running laser focused only on one industry, you build this incredible set of flywheels, and positive feedback loop is absolutely insane. We back the best enterprise talent who go on to change the world in which we live in, who then come back to their hometown, coach, and mentor the next generation of world-class enterprise talent. And don't take it just from me. Alchemist has backed the likes of LaunchDarkly, Rigetti, Privacera, MoEngage, FarmWise, just to name a few, many of which who have come back as mentors and coaches for the current classes of Alchemist. If you're curious and want to get more involved in the Alchemist ecosystem, check out alchemistaccelerator.com/superclusters. That's an S at the beginning and S at the end, and we'll include the link in the show notes below. Till next, stay awesome. It's David from Post here, and if you're tuning in from Spotify, Apple Podcasts, or wherever podcasts find your ear, it'd mean the world to me if you left a review. For those from the YouTube universe, let me know if you agree or disagree in the comments, and it'd mean a lot to me if you could share this episode with just one other person who'd get a kick out of today's topics. I'm on the road to publishing to at least 100 episodes of Superclusters, so every comment, question, review helps me make this experience more helpful, exciting, and fun for you. And lastly, I want to share a quick disclaimer. The views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. See you on the next.